1/5/2012. And good morning and happy Saturday and happy trading for the first calendar week of 2013. What I'm going to update here, I've already did the volatility index, the VIX, which is related to this S&P 500. One of the things that we would like to clearly show you during the fiscal cliff debates, they came out with the deal. And we're right back up at the calendar highs. We went through that 1450 area that I had talked about. I talked about 1475, 1490, slightly below the upper end of the trend line here is 1510. What I want to point out very clearly is when we go back over here, I'm going to blow up this chart. We're right back where the financial crisis started. There is going to be a debt ceiling and cost cuts by the government. And does government get shut down in February and March? That is much bigger than the fiscal cliff that we were dealing with over here. And what the government did. You all know it through the media or television or radio or whatever you know it, or you know it from us, for the followers that we have worldwide, is that volatility is to the upside to start the year of January. And we're going to come right back up to these highs that I had talked about. And I'm going to go right over here to this chart. I'm going to draw a trend line right here on the S&P. That's this high right here. That's 1486. The high end of the bar where we shorted this last year was right around the same area. It was 1474 was the 5.5-year high. And we're right back over here in calendar 2007 on this video here. The upper end is 1497, and slightly right above there is going to be 1503, these upper trend lines. Having said that, let's go all the way back over here. These upper trend lines are going to be the resistance level. This is a calendar year high that we have to break, which was also part of that 2007 and 8 area where it broke down from. And once again, when I show you MMT and the rest of our people, is that you need to know one thing as always, and we're accurate. This upside volatility resistance, we're going into an earnings season. The fiscal cliff was a big deal, but not nearly as big as a debt ceiling, how government shut down, and that is going to get really nasty. And it's going to start in the next couple of weeks. And we're going to go into a major resistance level again with the federal government. They went down to the very last minute on New Year. Actually, they went over December 31, and they did it on the first day of the year of 2013. Policymakers are going to become more challenged with the White House. It's going to get ugly. And the thing about it is we're going into earnings season at calendar almost 5.5-year highs. Each publicly traded company is going to release reports this month and throughout the month of January and into February. Then we're going to have the fiscal debt ceiling. That is 10 times more potent to the market than just the tax part. One thing about the tax revenue that they raised them, government on a monthly level, they take in now with the new tax increases, that's about $206 billion in tax receipts that come into the government. For the government at the current level, to operate the government, which is too big, is about $206 billion a month. They're going to have to make some horrendous cuts. And Mr. Obama doesn't even want to deal with cutting. That means that we're at $16 trillion. We're already at the top. We never resolved this back in 2011. Our credit rating got downgraded, everything. We already know all of that. And the people that follow us for years, you know exactly what I'm talking about in your live update today. This is going to be the upper end of the resistance, and we're going into a major earnings announcement with the slower growth. Growth is not at the high end of a bull run, but this is volatility. This is weekly volatility from 1400 to 1466 in the first calendar week. We're going to be looking at, as we go up higher, into resistance. We're going to look at how we can trade the S&P 500 when we're already going to buy the VIX calls. We already did that in the first video. And we're going to buy February contracts over here. And we're going to buy like $17 and $20 and up and out of the money. I already did this video. But now when it comes to the S&P 500, when I'm going to be making major resistance levels, there is a lot of headwinds that's going to hit these markets again. They're not going to resolve it as quick as they did. And one of the things that we're going to be looking at here in the S&P in the February contract, because we want to be the front line month out, because it's now January 2013, we're going to be looking at what's below the market here, right back where it started. And this is a $1,400 put for February. And I'm going to just throw that in the weekly chart here. Watch this. Here it is. It's never been this cheap. This contract, my friends, was up here. This is the high of the week. Here, let me show you, my friends. All of our viewers. I know you like being here because we're always buying wholesale. And when it comes to major resistance level and forward-looking potential doom and gloom, which it will be, they're not going to get that debt ceiling right. And Mr. Bonner got reelected. And I can tell you the Republicans, look at, if we don't cut the spending, we're going to be up toward 18 to 20 trillion dollars. And there's going to have to be some serious cuts. Now, if they don't, what will happen is the volatility will get bigger, but these are on sale. These were up here, my friends, at $45 a contract just 2 weeks ago during the fiscal cliff doom and gloom, meaning that they had traveled from this area of 1965 up to the highs. It was a big move in that short that we did. But now we are wholesale. We're down here at $8 a contract. And we can clearly see in here on the weekly, and I'm showing you the weekly handle, that the top down, this is wholesale. And the thing about it is, like always, we know when to buy wholesale because our risk is very minimal. We're going to be looking at that February $1,400 put down here at these levels on the S&P 500. That's the S&P 500 put options, 1,400 relative to the S&P 500, breaking up toward 5.5-year highs, going into a major earnings season up here. Give me a break. There's going to be some volatility with this debt ceiling. And that debt ceiling is going to have the same way that we went up starting the calendar year in January 2013. Right now, we can go right back down much harder and test right where it all started at 1350. That's another 100 handles below it. So upside volatility into resistance going into earnings. And not only that, the debt ceiling says that we get to buy and sell short the S&P once it comes up and challenge that 5.5-year high over here where we shorted it before. Those put options, which are below the market for February, are on sale at the $1,400 strike price. Now, just to keep things honest, let's take a look at the open interest here. Open interest right now is 36,000 contracts at the 1,400. The 1,420, which is on sale, only has 1,200. They got 19,000 of them, which is pretty heavy for the frontline month at 1,450, and they're buying these because they're cheap. And it's slightly right below the 5.5-year high at major resistance levels here in the S&P 500. We haven't been wrong on this trade, and we're not going to be wrong this time. Short term, the volatility will increase as we get in the middle of January and the latter part of January. But going into February, it's going to be ugly in these debt ceiling debates. And they're not going to give in like they did on the fiscal cliff, raising our taxes to pay for big government. And big government shutdown can happen, and our credit rating could go lower. And if they get in there and they kick this can down the road and the uncertainty starts to climb again, S&P 500 will go lower in value. February and March, We'll be looking at we're going to start with the February, and I'll be doing things with my other groups on the March contracts as far as my index puts go on the S&P. And it's very, very good because they're very, 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 very wholesale. Now, when I go to the monthly one, which is January calendar monthly one, on the same contract, there's 151,000 contracts open. But remember, this is a monthly contract and expires the third Friday of every month. It's not a weekly. But you can see here that when they took that S&P 500 up here to the all-time highs, look at the kind of premium that these people got whacked on. I mean, these things were $70 a contract over here. And I'm not joking. And they were just above $30 a contract. Now they're at 95 cents. That means that these people that had the January puts that didn't come out of them and sell them for a profit, they are losing money big, and they are cheap. And they're cheap enough for us to buy. Yes, this would be a very short-term trade, but the bigger, longer-term trade, and you can see this open interest here. 1420s, there's 10,000 open, 71,000 of the 1450s. They're cheap. Look at how cheap this is. You talk about cheap, I'm a master at wholesale. Look at, these were darn near, these were $57 a contract up here. They were $50 right here. If I'm buying this one at the 1450 and we close at 1466 and I buy these lower than what we see here, I am the lowest person on the street. I know how to play the reversal in the S&P at the very discounted price. It's all about wholesale. If you were holding them, and a lot of people do. A lot of hedge fund managers, they all get buried in these things. They didn't get out ahead of the volatility. And look what happens. They come down where I get to own them. Now, let's get back to the S&P 500. We're right up here, major wall of resistance. How do you buy the VIX calls and the S&P 500 puts going out to February for the longer term trade? And in the shorter term trade, there are weekly contracts that can be traded in here. Okay? And so we'll pick the different strike prices, and we'll probably do a couple of the weekly ones. Like I can just show you right here, this 1460, you're not going to have nearly the kind of data, but they were up here at $40. Right now they're at $12.90. And we're going to look at what the best options are for us on an intraday level. When the S&P hits that wall of resistance, we're still going to go to the frontline month, and we're even going to go out here to March. And I will be updating my other traders about where to buy these strike prices in March. You will get together with me privately, but I can tell you now that the March contract that was up here at $80 is down here. It's coming lower. It's a great contract as well. The S&P 500 can break that high, as we said. And I'll just tell you, we're coming right up here to it. And that's the wall of resistance. The minute that we start to use our intraday daily charts and our 60-minute charts, we'll know when that reversal comes. But no matter what, the SMF market maker division is the most wholesale on the street. Even all the very elite people that trade these index options are buried. They're buried in them. And they're buried in the January contracts. It can happen to everyone. Look at here. They had 98,000 of these contracts open on the 1350 put back in the fiscal cliff with the government. Look at what happened to these things. And here's what happens. Let it be. They were $40. They're down here at 38 cents. They were $15 up here before the fiscal cliff, and they dropped them all the way down. And big money buys these puts. As you can see, the conviction is in the open interest. 151,000 contracts right there. And on that 1350 that I just talked about, which is 98,000 contracts up here, I just want to send my message to you. They didn't know how to come out, and they were short the 1350, and they're lost all their money. It happens. There's 71,000 contracts open here. We're down here at 720. That's a 1450 put on the S&P. The S&P closed at 1466 on Friday, and we're at the top of the wall of resistance levels no matter what. And as we come up and hit it, here's what happens. They put in tops like this before they go down. Now that we've cleared a lot of stuff out, we're at the multi-yearly highs going into earnings season. There's going to be extreme volatility that picks up. And I'm giving the major update. And I'm giving the major update that we will not be wrong on this S&P 500 short as we go up and hit the resistance levels. That will be determined on an intraday level when it happens. It could come at any time. It could come with the gap open up. But who knows when it comes? It could come very quickly, and the trade will have to be made. And it gives you all the reason to get on our new alert service. S&P 500, put options, volatility index, S&P close at 1466, how to trade the S&P 500 when it fails again.